Have you ever looked at your savings account and thought, is this money really working for me? 6 months ago, I faced that exact question. I had $5,000 sitting idle, earning next to nothing. Instead of letting inflation erode its value, I decided to put it to work in a different way. No speculative crypto, no volatile meme stocks, and certainly no get-rich-quick schemes. My goal was simple yet powerful: to build a steady stream of passive income through real companies and their consistent dividends. This journey isn't about overnight riches, it's about sustainable wealth creation. It's a practical case study, based on real numbers and tangible results. I'll walk you through exactly what I invested in, how much income I generated each month, what strategies proved effective, and what lessons I learned along the way. By the end, you'll discover a key strategy that can empower anyone, from young adults just starting out to retirees seeking stable income, to begin their own passive income journey, even with a modest portfolio. Let's dive into the world of dividend investing. My primary objective wasn't to double my capital in a flash. Instead, I sought something more enduring, a reliable income stream that could support me whether I was working, traveling, or simply enjoying life. This is precisely where dividends shine. Dividends are essentially a share of a company's profits, paid out to its shareholders. Think of them as regular thank you payments from companies for your ownership. These payments arrive consistently, regardless of daily stock market fluctuations, offering a sense of financial stability. The true magic of dividend investing, especially for long-term wealth building, lies in reinvestment. When you choose to reinvest your dividends, a process often referred to as DRIP, Dividend Reinvestment Plans, those small payments automatically purchase more shares of the same company, or ETF. This creates a powerful compounding effect, similar to interest earning interest. Over time, your portfolio quietly expands, generating even more dividends, which in turn buy even more shares. It's a self-sustaining income machine that grows exponentially. This isn't about chasing fleeting trends. It's about cultivating a robust, long-term financial garden that yields fruit year after year. For retirees, it offers a predictable income supplement. For young adults, it's a powerful way to leverage time and compounding. And for passive income seekers, it's the ultimate hands-off income stream. Many beginner investors are drawn to the allure of rapid stock price appreciation. While growth stocks have their place, dividend stocks offer a different, often more reassuring, path. Companies that consistently pay and grow their dividends tend to be mature, financially stable businesses with strong cash flows. They have weathered economic storms and demonstrated a commitment to returning value to shareholders. This inherent stability makes them particularly appealing for those seeking to preserve capital while generating income. Consider the psychological benefit. Receiving regular payments, even small ones, provides tangible proof that your money is actively working for you. This can be incredibly motivating, especially when market volatility might otherwise cause anxiety. For those focused on financial planning, dividends offer a predictable component to your income projections, making budgeting and future planning much clearer. It's a strategy that emphasizes patience and consistency over speculation, fostering a disciplined approach to investing that pays off handsomely over the long run. To manage risk and optimize for both income and growth, I divided my initial $5,000 into 3 distinct buckets. This diversified approach ensures that no single investment can derail the entire portfolio, while allowing different types of assets to contribute to my overall goals. It's a balanced strategy designed for resilience and steady progress. This bucket formed the bedrock of my portfolio, providing broad diversification and professional management. Exchange-traded funds, ETFs, are ideal for beginners because they allow you to invest in a basket of stocks with a single purchase, instantly diversifying your holdings across many companies and sectors. SCHD Schwab US Dividend Equity ETF. This ETF is a cornerstone for many dividend investors, and for good reason. SCHD focuses on high-quality U.S. companies, with a consistent track record of paying dividends and strong fundamentals. It screens for companies with financial strength, consistent earnings, and a history of dividend growth. This means you're investing in financially sound businesses that are likely to continue increasing their payouts. For me, SCHD provided a reliable, diversified exposure to dividend growth, offering a yield typically in the 3.5% to 4% range. It's a set-it-and-forget-it type of investment that does the heavy lifting of identifying quality dividend payers. VYM, Vanguard High Dividend Yield ETF. Complementing SCHD, VYM focuses on U.S. companies that pay higher than average dividends. While SCHD emphasizes dividend growth, VYM leans towards higher current yield CAMs. This combination provides a balanced approach. SCHD for long-term dividend appreciation and VYM for more immediate income. Together, these two ETFs offered broad market exposure, reduced individual stock risk, and provided a solid foundation of consistent income, making them perfect for both beginner investors and those seeking reliable passive income. This segment focused on established, financially robust companies known as blue chips. These are often industry leaders with long histories of profitability and dividend payments, sometimes even earning the title of dividend aristocrats. Companies that have increased dividends for at least 25 consecutive years, or dividend kings, 50+ years. Investing in these companies offers stability and a high degree of confidence in their continued payouts. Johnson & Amp. Johnson, J&J. A global healthcare giant, J&J operates across pharmaceuticals, medical devices, and consumer health. Its diverse business segments provide incredible stability, making it a reliable dividend payer. J&J is a dividend king, having increased its dividend for over 60 consecutive years. This track record speaks volumes about its financial resilience and commitment to shareholders. Procter & Amp. Gamble, PG. The consumer staples powerhouse behind brands like Tide, Pampers, and Gillette. PG's products are essential, meaning demand remains relatively stable even during economic downturns. This consistent demand translates into reliable cash flow, allowing PG to be a consistent dividend payer and a dividend king for over 67 years. Coca-Cola, KO. A global beverage icon, KO's brand recognition and vast distribution network ensure consistent sales worldwide. Its products are consumed daily by billions, providing a stable revenue stream. KO is another dividend king, with over 62 years of consecutive dividend increases, making it a bedrock for income-focused portfolios. PepsiCo, PEP. Similar to Coca-Cola, PepsiCo offers a diversified portfolio of beverages and snacks, e.g., Lay's, Doritos. This diversification provides resilience. PEP is a dividend aristocrat, having increased its dividend for over 50 consecutive years. Realty Income, O. Uniquely, Realty Income is a real estate investment trust, REIT, that pays dividends monthly. It owns a vast portfolio of commercial properties leased to various tenants, providing a stable rental income stream. Its monthly payout schedule is a significant draw for passive income seekers, offering more frequent cash flow than the typical quarterly dividends. Realty Income has paid 647 consecutive monthly dividends and increased its dividend for 106 consecutive quarters. These individual blue-chip stocks provide a blend of stability, long-term dividend growth, and in the case of Realty Income, monthly income, making them attractive to both retirees seeking consistent payouts and young investors building a foundational portfolio. This final bucket was allocated to companies that might not offer high current dividend yields but possess strong growth potential and a commitment to steadily increasing their dividends over time. These are often market leaders in innovative sectors. The idea here is to capture capital appreciation while also benefiting from future dividend growth. Apple, AAPL. While known primarily as a growth stock, Apple initiated a dividend in 2012 and has consistently increased it since. Its massive cash flows and dominant market position in consumer electronics, software, and services provide ample room for continued dividend growth. Investing in AAPL here was a bet on its continued innovation and market leadership, which would eventually translate into more significant dividend payouts. Microsoft, MSFT. Another tech titan, Microsoft has a long history of paying and growing its dividend. Its diversified revenue streams from cloud computing, Azure, enterprise software, Office 365, gaming, Xbox, and hardware make it incredibly resilient. MSFT represents a blend of robust growth and a steadily increasing dividend, making it a compelling choice for long-term investors. Starbucks, SBUX. The global coffee giant, Starbucks, has expanded its dividend significantly since initiating it in 2010. Its strong brand loyalty and global expansion potential suggest continued revenue and profit growth, which can fuel future dividend increases. SBUX offers exposure to the consumer discretionary sector with a growing dividend profile. This slow grower segment adds a dynamic element to the portfolio, balancing the stability of blue chips and ETFs with the potential for higher capital appreciation and accelerating dividend growth over the long term. It's a strategy that appeals to young adults who have time on their side to let these companies mature into larger dividend payers. After careful consideration, I allocated $4,700 of my initial $5,000, keeping $300 in cash for potential reinvestment opportunities or to take advantage of market dips. Here's the precise breakdown of how the funds were distributed across the three buckets. SCHD $1,250, 26.6% of invested capital. VYM $1,000, 21.3% of invested capital. JNJ $500, 10.6% of invested capital. PG $400, 8.5% of invested capital. KO $300, 6.4% of invested capital. PEP $300, 6.4% of invested capital. O $300, 6.4% of invested capital. MSFT $300, 6.4% of invested capital. AAPL $250, 5.3% of invested capital. SBUX $100, 2.1% of invested capital. This allocation reflects the strategic balance I aimed for: a strong foundation in diversified ETFs, a significant portion in stable blue-chip dividend payers, and a smaller yet meaningful allocation to growth-oriented dividend stocks. This structure is designed to provide both immediate income and long-term growth potential, catering to the diverse needs of dividend enthusiasts and passive income seekers. Watching the dividend payments trickle in was incredibly motivating. It transformed abstract investment concepts into tangible, real-world income. Here's a month-by-month breakdown of what this $4,700 portfolio actually paid me over the first 6 months. December. My very first payout came from the monthly dividend payer, Realty Income. $1.75. Initial thoughts: small, but it's a start. This is real money, earned passively. January. The dividend stream began to build as more companies paid out. PG $2.50. PEP $2.30. O $1.75. Total $6.55. Observation: notice how the payments are starting to accumulate. This is the early stage of the snowball effect. February. A quieter month, but Apple joined the party, alongside Realty Income. APL $1.50. O $1.75. Total $3.25. Lesson: dividend schedules vary. Some months will be lighter than others. Patience is key. March. This was a significant month, with major ETFs and several individual stocks paying out. SCHD $10.94. VYM $7.50. JNJ $3.38. MSFT 83 cents. SBUX 38 cents. O $1.75. Total $24.78. Highlight: this month clearly demonstrates the power of diversification across different payout schedules. The combined effect is much larger. April. Another solid month, with consumer staples and Realty Income contributing. PG $2.50. PEP $2.10. KO $2.25. O $1.75. Total $8.60. Insight: the consistency of these payments, even if small, reinforces the passive income concept. May. Apple and Realty Income again provided income. APL $1.50. O $1.75. Total $3.25. Reinforcement: the pattern of quarterly payments from most companies becomes clear. Total dividend income over 6 months $52.71. From a modest $1.75 in December to nearly $25 in March, this progression illustrates the steady, compounding nature of dividend investing. While $52.71 might not seem life-changing, it's crucial to remember this is just the beginning. This income was generated purely from my capital working for me, without any additional effort on my part. It's a powerful demonstration of how even a small initial investment can start building a real, tangible income stream. For beginner investors, this early success can be incredibly encouraging. proving that passive income is not just a theory, but an achievable reality. My first 6 months provided invaluable insights that are crucial for any aspiring dividend investor. These lessons go beyond just picking stocks. They're about understanding the philosophy and practicalities of building a resilient income portfolio. It's tempting to look for stocks offering incredibly high dividend yields, say 8% or 10%. However, a yield that seems too good to be true often is. An unusually high yield can be a red flag, indicating that the company's stock price has fallen significantly, which inflates the yield percentage, or that the dividend itself is unsustainable. Companies with struggling financials might be forced to cut or suspend their dividends, leaving investors with a lower income stream and often a depreciated stock value. My focus remained on quality companies with sustainable payouts, even if their yields were more modest. Prioritize dividend safety and growth potential over an inflated current yield. This is a critical financial planning principle for long-term success. Not all dividends are paid at the same time. Most companies pay quarterly, every 3 months, while a few, like Realty Income, pay monthly. Some ETFs might have their own unique schedules. It's important not to panic if a particular month feels quiet in terms of income. It simply means that the companies you own have different payout cycles. By diversifying across various stocks and ETFs, you can create a more consistent flow of income throughout the year, even if individual payments are quarterly. This understanding helps manage expectations and reduces anxiety, especially for new investors. Putting all your eggs in one basket is a recipe for disaster in investing. My 3-bucket strategy was designed specifically for diversification. Don't put all your money into a single stock, a single sector, or even just one type of dividend payer. A mix of broad market ETFs, stable blue-chip companies, and growth-oriented dividend stocks provides resilience. If one company or sector faces headwinds, the others can help cushion the impact. Diversification is your primary defense against unforeseen market events and ensures a more stable income stream over time. This principle is fundamental for sound financial planning. This is arguably the most powerful lesson. While it might be tempting to cash out those small dividend payments, resisting that urge and reinvesting them is where the true compounding magic happens. By automatically buying more shares with your dividends, you accelerate the growth of your portfolio. Those newly acquired shares then generate their own dividends, which buy even more shares, and so on. This snowball effect is incredibly potent over the long term. For young adults, this is how you build substantial wealth. For retirees, it's how you ensure your income stream continues to grow, helping to combat inflation. Always enable DRIP if your brokerage offers it. This initial 6-month period was just the beginning. My commitment to building this passive income machine is long-term. Moving forward, I plan to consistently add $200 per month to my portfolio. This regular contribution, combined with dividend reinvestment, will significantly accelerate the growth of my income stream. Here's my strategic plan for the coming months. Add more to S, CHD, and VYM, especially during dips. These ETFs form the core of my portfolio due to their diversification and quality. I will prioritize adding to them, particularly when market pullbacks offer opportunities to buy shares at a lower cost, effectively increasing my yield on new investments. Slowly increase my position in Realty Income. The monthly dividend from Realty Income is a fantastic component for consistent cash flow. I aim to gradually build up this position to enhance my monthly income stream. Add dividend growers like Home Depot HD. I'll continue to seek out high-quality companies with strong fundamentals and a history of consistent dividend growth, even if their current yield isn't the highest. Home Depot, for example, is a retail giant with a solid track record of increasing its payouts. Keeps DRIP enabled across the board. The power of compounding is non-negotiable. Every single dividend payment will be automatically reinvested to purchase more shares, ensuring my portfolio continues to grow organically. By the end of the year, with consistent contributions and reinvestment, I fully expect my annual dividend income to cross the $200 mark. While this isn't life-changing money today, imagine the potential of this income stream growing over 5, 10, or even 20 years. It's a snowball that gains momentum with every passing month, compounding without me lifting a finger. This long-term vision is what drives the strategy, offering a clear path for financial independence and security for all audience segments. This journey isn't about chasing quick flips or flashy speculative profits. It's about building something far more valuable and reliable, a sustainable income stream that shows up month after month, year after year, through market ups and downs. It's about financial empowerment, taking control of your money and making it work for you. The most important takeaway is this: you don't need a massive amount of capital to start. Even with just $5,000, or even less, you can begin building real passive income. The key is to start, stay consistent, and embrace the power of compounding and reinvestment. This strategy is accessible to everyone, from young adults looking to build a strong financial foundation, to dividend enthusiasts refining their approach, to passive income seekers desiring financial freedom, and retirees seeking stable, growing income. If you found this case study helpful and feel inspired to start your own dividend journey, remember that knowledge is power. Explore resources, understand the companies you invest in, and commit to a long-term perspective. We're here to help everyday investors build smarter, more sustainable portfolios, one step at a time. Ready to take control of your financial future? Don't let your money sit idle. Start your dividend investing journey today, even with a small amount. Like this video to show your support, subscribe to our channel for more relatable investing content, and share this with a friend who needs to hear this message. Let's build our income machines together. See you in the next one.